Have we reached the market bottom? With the dollar falling, implied volatility dropping, and liquidity rising, some analysts think a massive rally is on the horizon. Peter, what if I were to tell you that Bitcoin can reach $250,000 by summer?
What? No. Wait. Okay. Bitcoin right now is at 86.3.
Right?
You're saying it can get to 250 by July?
By July, yeah, by July.
But I thought didn't we just do a whole thing about because recession, then liquidity pump?
Well, the liquidity has already started pumping. So here's the funny thing. The way recessions work is that the recession in the economy happens, or the recovery of the assets, of risk assets, crypto and equities and all that, happens before what happens in the economy. Like basically, the markets front run the recession, and so markets can actually start going up while the recession is just now hitting Main Street.
Yeah, you told me one time that job loss is the last step in the recession, although it might be perceived as the
No,
first step by the population.
no, in the series of things that could happen that leads up to that, it starts all the way with uh, procuring of the basic materials in the supply chain, all the way down to manufacturing, to refinement, to wholesalers, to retailers, and then to you and me, retail. And so when the unemployment rate ticks up, more people are out of work. Like all that has already happened before, and it's the last sign before recession starts.
Oh, I see.
Yeah, so it's the other way around. But I just wanted to play something from Tom Lee. This won't be a long segment. Let's hear here. So this is Tom Lee, famous investor. Like him or hate him, he has his things to say. Let's see what a lot of people respect him.
I too remain pretty optimistic through all of this. Are you still?
Yeah, I am optimistic. I mean, I can understand why investors are sitting on their hands. I mean, they don't really know how severe these tariffs are going to be, how long they are, but now we're seeing a big price correction, a decline in sentiment, and then something like today, we got a bad ADP jobs report, and the market's actually up. So we're actually rising on bad news, which is a good sign that a lot of bad news is priced in.
But do you agree with that? I mean, it's one thing for CEOs to be a little skittish, be a little more cautious. I mean, that's what they get paid to do. Investors often have to place their bets before something takes place. Is this a buy, this unsettled market that we've witnessed recently?
I mean, yes. In my mind, we put out a piece yesterday just talking about the 10 best days that happen every year. Last year, for instance, the 10 best days added up to 21 percentage points of the S&P. X those 10 days, the market was only up 4%. So, you don't get 20% years because it's good through the year. It's just the 10 best days. I think the setup for a 10 best day is near because if the economy's near stall speed, I think people realize the Trump put does come back because otherwise it has to unwind all this austerity. And if the job market's soft, the Fed put comes back into play because the Fed doesn't want to play with stall speed. And I think that's what is going to be the positive catalyst in the next couple of weeks. And on top of that, we already know stocks will bottom before bad news peaks. And so if we're seeing the market not fade on bad news, that means we're already priced in.
All right, so we've been talking about for a couple of months now that the window of weakness that Ken Carson talks about, which is period between February 20th and March 20th, is this window, this quarterly OPEX period, where if a catalyst happens, you can get a massive drop within the markets. But barring that, there's usually enough liquidity or enough liquidity and vol supplied that allows for the markets to suffer bad news in stride. Right, so this constant buying of the market that's happening for various reasons, funds, passive investing. There's all this mechanism where this indiscriminate buying of the market, not because they want to, just because it happens automatically, that stops or fades within these 4 periods of the year, and then so if that stops, then you can have a drop. But other than that, you get this upward move. So he's saying over here that he believes that basically the lows are in for the markets. He's not seeing a 50% correction on the stock market. I also wanted to 1 second here. We talked about before how the dollar is falling, and that'll take about we're going to see a liquidity injection over here. Let me just share my screen real quick. You're seeing here on the Christensen liquidity indicator that if we offset, I offset liquidity by 78 days. And you can see this is Bitcoin, a chart of Bitcoin. You can see how pretty accurate. Let's hide all these other lines. All right, so you can see how pretty accurate it can be, where this is liquidity. I mean, tell me that's not basically 1-for-1 for these things, right? Up and then down and then down and then sideways. So basically, we have this liquidity coming back in around April of this year, and it's a rise of liquidity up to match where we just were to 100,000. So my expectation is that we blow to that we maybe stay a little bit sideways, maybe head down a little bit lower to 74,000, and then we rocket up after this window of weakness, March 20th, to either the same high or all-time highs. And the idea here is that as the dollar keeps falling, this should continue to go up. And when we take a look at the dollar, right, the dollar has broken lower. I mean, it shows no sign of stopping until we get down to the 100 mark. So we have another 40% of the drop left, and that's more than enough liquidity down the road in order to buoy markets. And take a look at where we are in markets. Like if we take a look at Nvidia, fine, it's down. This is AI, right? Nvidia chips, we're down 30% off the top. But we look at stuff like HIMS. HIMS is down. 1 second. Yeah, HIMS is down 50% from the high. We have stuff like Victoria's Secret down 60%.
These are all buying opportunities.
Right. So if you're going to buy these things at all, maybe not Victoria's Secret, but if you're going to be buying these things at all, now's the time to get them, right? It's at these moments that you want to buy these stocks. So that's pretty interesting. And finally, if we take a look at, pull this up real quick. If you take a look at implied volatility, which is how 1 second here. Implied volatility is the implied risk of what will happen to an asset in the future. So the higher implied volatility is, the more people think that something bad could happen in the future. If we take a look at Tier 1 Alpha, they're talking about how this is a skew, volatility skew, and it's basically saying the higher this is, the more that there is worry about the markets around that time. So this is March 9th we're talking about over here, and this in the future, April. So it's saying that, hey, if we get past this period here, this March to March 20th, this is what I was telling you about before. If we get past this period and no big catalyst happens while liquidity is low, then chances are we're not going down, because over here, the implied volatility is low. Does that make sense, Peter? Like you sort of need a bunch of people who are not positioned, they're not safe, they don't have any insurance, so that when a catalyst happens, they have to chase. They got to sell their assets really quickly. They don't know how far it's going to go. They have to buy protection, and you get this exacerbation to the downside. But if you are insured, you almost make more money on the downside, right? On options, you can make sometimes 10 times more money on the downside. And so then you end up with more capital as the price falls. People monetize that and then put that money right back into the market, and you get this V up, the shoot back up, like we saw in COVID, Volkswagen, and all these different times where the price just skyrockets. And so time is ticking. It's March 7th. Let's see what March 20th brings around. But liquidity is increasing, and inflation's coming down for a bit. It could be a catalyst to a big move up. Now, I think after that, my whole pitch is that we're going to see volatility that like we've never seen, and we've already seen that. Is that after that rise up, we get that's where the real recession begins, and we get just a massive drop. I think Bitcoin tops, and we come down to the cycle low, which I believe is something like 30,000. I haven't checked on it recently. So you want to sell at the next the next high, but and then after that recession, while we're in there, you want to be buying, because over the next 10 years, you might really clean up. That's my pitch. The automated trading platform designed to take the friction out of executing your strategies. Whether you're trading stocks, futures, or crypto, TradersPost connects seamlessly to your broker or exchange, giving you the flexibility to automate your trades without missing a beat. If you're tired of being the bottleneck in your own success, it's time to let automation do the heavy lifting. Head over to TradersPost.io and see how easy it is to streamline your trading. TradersPost, because your strategy deserves to run at full speed.